Apple, AAPL, closed yesterday just 3.64% below its 52-week high and is showing a technical option rating of a strong buy. When running a stock screen for Dow Industrial Stocks, we can see that AAPL stock has one of the lowest 4 ranks of all Dow stocks. So, given that AAPL is rated a strong buy and implied volatility is low, what option strategies might be appropriate? Well, we want to focus on bullish strategies due to the strong buy recommendation, positive Vega strategies due to the low implied volatility rank. Let's take a look at a few different option ideas on AAPL stock given the above parameters. Bull call spread. The first strategy is a bull call spread. A bull call spread is created through buying a call and then selling a further out of the money call. Selling the further out of the money call reduces the cost of the trade but also limits the upside. A bull call spread is a risk-defined trade, so you always know the worst case scenario. Bull call spreads are positive delta, bullish, and positive Vega, benefit from a rise in implied volatility. Going out to May expiration, a 175 strike call option was trading around $10.90 yesterday, and the 180 call was around $8.35. Buying the 175 call and selling the 180 call would create a bull call spread. The trade cost would be $255, difference in the option prices multiplied by 100, and the maximum potential profit would be $245, difference in strike prices, multiplied by 100 less the premium paid. A bull call spread is a risk-defined strategy, so if AAPL stock closes below 175 on May 20th, the most the trade could lose is the roughly $255 premium paid. Potential gains are also capped above 180, so no matter how high AAPL stock might go, the most the trade could profit is $255. In terms of trade management, if the spread dropped from $255 to $125, or if the stock dropped below 169, I would consider closing early for a loss. Let's take a look at another potential option strategy. Bullish calendar spread. Assuming a trader had a target price for AAPL of 180, they could set up a bullish calendar spread centered at that price. A calendar spread is a trade that involves selling a short-term option and buying a longer-term option with the same strike price. Bullish calendar spreads are positive delta, bullish, and positive Vega, benefit from a rise in implied volatility. Selling the March 18, 180 strike call option will generate around $360 in premium, and buying the April 14, 180 strike call will cost around $565. That results in a net cost for the trade of $205 per spread, which is the most the trade can lose. The estimated maximum profit is around $305, but that can vary depending on changes in implied volatility. The idea with the trade is that if AAPL stock trades up to around 180, the calendar spread will increase, resulting in a net profit. A bullish calendar spread is a good way to gain some upside exposure on a stock without risking too much if the move doesn't eventuate. The ideal scenario is a rise up to 180 around March 18 with little change, or a rise, in implied volatility. The combined position has a net delta of 4, which means the trade is roughly equivalent to owning 4 shares of AAPL stock, although this will change as the trade progresses. For a trade such as this, I would set a profit target of 30% and a stop loss of 20%. The final idea we will look at is a long call option trade. Long call option. One of the benefits of call options is that they provide leverage. This can be both a good and a bad thing. Assuming an investor wanted to buy 100 shares of AAPL stock, they would have to invest around $17,600 at the current price. Instead, the investor could gain a similar exposure using a fraction of the capital by buying a call option. One call option gives the investor exposure to 100 shares. Like the previous 2 example, A long call option is positive delta and positive vega. If an investor were to buy one AAPL 160 call option expiring on May 20th, they would only need to invest around $2,075 rather than $17,600. The break-even price for this call option is equal to the strike price plus the premium paid, which would make the break-even price $181.75. The most the trade can lose is the premium paid of $2,075, which would occur if AAPL finished below 160 on May 20th. However, if AAPL stock shoots higher, the upside is unlimited. Using options in this way can be a great way to gain exposure to a stock without risking as much capital as would be required to buy the stock outright. Conclusion. There you have 3 different bullish, positive vega trade ideas for AAPL stock, but you can use these strategies on any stock with a low 4 rank and a strong buy rating.